Welcome to the Deep Dive, your shortcut to getting smart on the latest market moves. Today we're diving into the Q2 2025 earnings call for Oil States International. Now, this is a company facing, well, really two different environments in energy right now. You've got this choppy U.S. land drilling scene, and then this deeper, maybe more stable international offshore current. Our goal here is to figure out how they're handling both and what it all means for you, our listener, and maybe the wider sector.
Yeah, you've really hit the nail on the head there. Oil States, they definitely presented a quarter with some real contrasts. You see strong strategy, good execution in some spots, capitalizing on growth, but then they're also, smartly dealing with these wider market headwinds elsewhere. We need to unpack this balancing act, see where they're headed.
Absolutely. So we're here to get through all that noise, pull out the essential bits you need. We want you to really get the company's performance, management's thinking, and what signals this might be sending about energy overall. So we get a quick summary first, then our deeper analysis, and maybe even something to chew on afterwards. Okay, let's jump right in. Headline numbers for Q2 2025. Oil States reported adjusted earnings per share, EPS, of 9 cents.
Only signs.
0.9 cents. Now that was pretty much in line. Maybe slightly better than the street's range of 8 to 9 cents. So okay on the bottom line. But the revenue figure, that came in at $165.4 million. And that missed the consensus expectation, which was around $170.7 million. So short by about $5.3 million. Bit of a mixed picture there, wouldn't you say?
Oh, definitely. That mix, it set a cautious tone right away for a lot of people. Now, their adjusted EBITDA, that's, earnings before interest, taxes, depreciation, amortization, a key profitability metric, it landed right when management guided. Between $20 and $22 million came in at $21.1 million. So operationally, they hit their mark. But yeah, that revenue shortfall, that was undeniably what the market focused on, although on the plus side, and maybe folks miss this a bit, they generated a solid $8.1 million in free cash flow. That shows pretty effective management, actually. Still making cash even with the top line pressure.
Right. So you've got this picture of a company adapting, conditions are challenging, and the market reacts fast, maybe focusing just on that revenue number. But does that reaction really tell the whole strategic story? Are we missing something bigger here?
That's the key question, isn't it? The revenue miss grabbed the headlines, sure, but the strategic stuff, especially what's happening offshore, that's a much more nuanced and, frankly, a much stronger story. The real deep dive starts when you ask why the numbers landed this way.
Exactly. And the big story really is this very clear, very deliberate pivot Oil States is making towards offshore and international markets. Cindy Taylor, the president and CEO, she pointed out this number. 72% of their consolidated revenue in Q2 came from these projects. That's a huge jump, not just from last quarter, but year over year too. What does that 72% really signal?
Well, it signals resilience, for one. It's fascinating how strong these markets are holding up. I mean, think about it. Geopolitical instability, oil prices bouncing around, trade policy shifts. Despite all that, offshore and international showed real strength. And their Offshore Manufactured Products segment, OMP, that was a particular bright spot. Revenues there were up 15% sequentially, and even better, adjusted segment EBITDA rose 18%. So not just more sales, but more profitable sales in that core offshore business.
And it's not just a blip, right? It's baked into their orders. The OMP segment booked $112 million in new orders this quarter. That's strong. And the really telling part is the book-to-bill ratio, 1.1x. So for every dollar they build, they booked $1.10 in new work. That's growth, plain and simple. And maybe the headline number here, this pushed their total OMP backlog to $363 million. Now, you mentioned this is the highest that backlog has been since September 2015. In this kind of industry, what does a backlog that big actually mean for their future, especially now?
It means visibility, huge visibility, which is like gold in uncertain times, right? Management stresses this point. Their offshore work is mostly for production infrastructure. We're talking large fields, already drilled, already discovered. These are multi-year projects, sometimes multi-decade developments. Think big subsea systems, platform connectors. This isn't the kind of spending that gets cut just because oil dips for a few months. It's essential, long-term stuff. Makes it much less vulnerable to short-term economic wobbles compared to, say, U.S. land activity. It's a different animal. Provides a really stable base.
Okay, so one side is this thriving, long-cycle offshore business. But the flip side, the U.S. land drilling and completion side, that saw a pretty sharp decline. Rig count down 8%, frac spread count, the active fracking units down 14% since the end of March. It really does feel like two different worlds operating at the same time. What's hitting U.S. land so hard?
That's exactly that two oceans idea you brought up. The U.S. land decline, it's driven by a few things hitting at once. Weaker crude prices, obviously, that hurts U.S. shale economics directly. General macroeconomic uncertainty makes people hesitant. And significantly, OPEC plus decisions, when they start unwinding production cuts, adding supply, that tends to pressure prices downwards, makes U.S. drilling less attractive.
Yeah.
So operators pull back, and that hits companies like oil states that play in both fields.
So given that tough environment, how's oil states actually responding on the U.S. land side? Just riding it out? We're taking action.
Oh, they're definitely taking action. Actively restructuring is how they put it, right-sizing the business. They made a specific strategic call in Q2 to get out of 3 more land-based facilities, and they trimmed their U.S. land workforce further. Now, yes, doing that cuts revenue from what they call commoditized product lines, the less specialized, lower margin stuff. But, and this is key, management insists it's not really hurting EBITDA much. In fact, they argue it's improving free cash flow because they're ditching operations that were just marginal, sucking up resources.
That's a bold call, isn't it? Shedding revenue now for gains later. This term high grading keeps coming up. Can you expand on that? What does high grading look like in practice here? And what's the end goal for U.S. land?
Right, high grading. Basically, they're pruning the less desirable branches, cutting the less profitable, more volatile U.S. land stuff. It's not just random cuts, though. It's strategic optimization. They mention specific things like aggressive cost cutting, consolidating into fewer, more efficient hubs, and deliberately shifting focus within land towards more specialized, higher value services, moving away from the basic commodity products. The aim is to keep only the really profitable bits, and the target they've set is pretty ambitious. They expect the go-forward adjusted EBITDA margins for U.S. land to almost double by 2026, getting up into the upper 20s, maybe low 30s% range. That's a huge jump in profitability for that segment, even if the overall size is smaller.
Well, yeah, doubling margins, even on less revenue, that definitely changes the profile of that business. Okay, moving beyond operations, let's talk capital allocation innovation. Lloyd Huddick, the CFO, mentioned they bought back $7 million in stock and $15 million of their convertible notes in the quarter. At a discount, too. What's the strategy behind that?
That's all about strengthening the balance sheet. Deleveraging. Their clear goal is to get to net debt zero by April 2026 when those convertible notes mature. And that's not just housekeeping. A company with zero net debt has way more financial flexibility. It often gets valued higher by the market, too, so it unlocks equity value. They also tweaked their asset-based lending facility, the ABL, in late July. Basically lets them borrow more against their assets, like receivables, and at lower interest rates. Again, more flexibility, lower future interest costs, just prudent financial management supporting the bigger strategy.
And they're still investing, too. CapEx was up in Q2. They raised the full-year guidance to $30 million. A big piece of that is this new manufacturing plant in Batam, Indonesia. It's almost done, Q3 completion. This isn't just adding capacity, is it? What's the strategic importance of Batam?
No, it's much more strategic than just another factory. Batam is, it's like a beachhead into that fast-growing Asia-Pacific offshore market. It means quicker delivery within the region. It helps to diversify their manufacturing, reducing some geopolitical supply chain risk. And crucially, it positions them to compete better for those big multi-decade subsea projects in Asia, stuff that was maybe harder to service efficiently from elsewhere. It's really an investment in future growth in their best segment.
And innovation matters too, right?
Yep.
They got an award, a 2025 Meritorious Engineering Award from Hart Energy. It was for something called the Low Impact Workover Package. Why is that significant? What problem does it actually solve out there?
Right, that package. It basically combines some proven technologies in a smart way to make subsea well plug and abandonment P&A operations better, more efficient. And why does that matter? Because globally, a lot of offshore infrastructure is getting old. Decommissioning these old wells safely and efficiently is a huge, complex, and very expensive task for operators. So Oil State's solution helps cut the time needed, reduces the environmental impact, and ultimately saves the operators money. It's a specialized, high-value service tackling a growing need in the industry dealing with aging assets. Shows they're focused on solving real problems.
Okay, so looking forward, management updated their outlook. They kept the full year 2025 adjusted EBITDA guidance the same. $88 million to $93 million. So confidence and profit. But because that U.S. land streamlining, they did lower the full year revenue guidance to $685 million to $700 million. What should we make of that divergence? Profit guidance steady, revenue guidance down.
It tells a very clear story, I think. Oil States is explicitly choosing profitability over pure revenue volume. They're willing to let go of that lower margin, commoditized land revenue to protect and hopefully grow overall profit. For Q3 specifically, they guided to revenues of $165 to $170 million and EBITDA of $21 to $23 million. Kind of steady state from Q2. But the full year guidance implies things really ramp up in Q4, both revenue and EBITDA, and that expected Q4 jump. That's mostly driven by the O&P segment converting that big backlog into actual revenue as projects progress. So it reinforces the visibility they have offshore. It's a strategic trade-off. Less revenue now from land, expecting stronger, more profitable results later, mainly from offshore.
Okay, so we're definitely hearing this clear narrative, managing these two cycles, leaning into offshore strength while strategically shrinking and optimizing U.S. land. But given all these moving parts, this complex story, how did the market actually react?
Well, the immediate reaction wasn't great. Despite the EPS beat and the strong offshore news, the stock fell pretty hard, something like 11% to 13% on July 31st. Ended the day down in the, $5 range. And that seems largely down to the revenue miss and just ongoing worries about the U.S. land pressures. Unfortunately, that seemed to overshadow a lot of the positive operational stuff and the long-term strategy. Classic case of miss the top line, pay the price.
Yeah, it's that classic disconnect, isn't it? Management's talking sequential gains, great bookings offshore, long-term vision. But the market's maybe stuck on that immediate revenue number. Does that put pressure on them to change course, or is it just short-term noise?
That's always the tension, right? The market reaction hurt, no doubt. But interestingly, analyst sentiment, you look at firms like Raymond James, Stifel, they stayed cautiously constructive. They kept their buy ratings. And they specifically pointed to the strong offshore backlog and how the business mix is improving, shifting to higher margins. So that's just a longer-term view is still out there, one that values the strategic positioning over these short-term revenue dips from the planned exits. They seem to see past the immediate reaction.
So pulling it all together for you, the listener, what's the bottom line here for oil states and maybe the wider energy space?
I think the bottom line is that oil states is very much in transition, a critical one. These strategic moves are all aimed at building a more profitable, more stable company long term. Focus on the higher margin, predictable offshore work, and really fix or shrink the challenged U.S. land assets. Yes, the macro environment, weaker oil prices, cautious spending by majors, OPEC plus moves, that's definitely hitting U.S. land hard. But at the same time, analysts see this bigger global shift happening towards offshore exploration and development, driven by the need for lower cost, maybe lower carbon resources. And that trend plays right into oil states' strengths and where they're steering the ship. They're positioning for that next phase of energy.
Okay, now for the part where we stretch the boundaries a bit, this is absolutely not financial advice, but if we had to pitch an idea, maybe a wild but plausible trade based on everything we've just discussed for Oil States International, what would it be?
All right, playing that game. Given how the market reacted, maybe a bit viscerally to the revenue miss, but also acknowledging the underlying strategic improvements and that strong offshore backlog, you could theoretically consider a long position in Oil States International, ticker OIS, combined with a short position in a broad U.S. energy ETF, maybe like the Energy Select Sector SPDR Fund, XLE.
Okay, explain the thinking there. Long OIS, short the broader sector via XLE. Yeah. The idea is OIS is actively high grading. They're ditching the less good stuff, the volatile lower margin U.S. land operations, become more focused, more profitable, leaning into offshore and international. That projection, doubling U.S. land margins by 2026, even with less revenue. That's based on real actions, cost cuts, shifting services. It suggests there's potential for the market to re-rate OIS. Potential the market is just missing right now because it's fixated on that revenue number.
Exactly. So going long OIS is a bet on that specific company's turnaround, on them executing the strategy, converting that record backlog. You're isolating their story. Then shorting XLE hedges against the broader sector risks, the U.S. land weakness, the macro jitters that could keep weighing on energy overall, things OIS is trying to mitigate with its shift. The potential divergence, if OIS executes well while the broader sector maybe stays sluggish, could be quite significant.
So definitely a contrarian play. You're betting on company-specific things, like the Batam facility boosting things in Q3, like continued strong offshore orders, like hitting those land margin targets, betting that these specific catalysts will let OIS outperform the general sector noise. Outrageous. Maybe a little plausible. We think there's a case to be made. Okay, so let's recap. Oil States International's Q2, really a tale of two very different market cycles being managed at once. You've got strong offshore and international results, backed by that record backlog, plus strategic investments like the new Batam facility and innovation like that Low Impact Workover Package, pushing them forward in higher value areas.
And at the same time, management is taking pretty aggressive steps to optimize, to right-size their U.S. land business. It's a move clearly designed to boost future margins and cash flow, even if it means lower revenue numbers right now. The market's sharp reaction really underscores that tension, doesn't it, between short-term numbers and these longer-term strategic plays.
It's definitely a company in motion. Seems laser-focused on building a business that's more resilient, higher margin, and better positioned for where energy might be going. We really hope this deep dive has given you a clearer, maybe more nuanced view of their strategy and what happened in Q2.
And just to reiterate, please always remember, the information we've shared today, it's purely for informational and educational purposes. It is absolutely not financial advice. You should always do your own research and definitely consult with a qualified financial advisor before making any investment decisions.
Thank you so much for joining us on the deep dive. We really appreciate you tuning in and staying curious. We look forward to digging into another topic with you next time.